So, hey guys, welcome back to Accelerated Investor. Hey, it's Josh, your host. And listen, today I wanted to record a quick podcast for you and an update on one of our assets. We call it 220 Chevy, otherwise known as Forest Ridge Apartments. And today I'm going to tell you about where we bought it at, kind of the high watermark of where we got to with operations, with collections, and then where we're at today and how the value of the building has changed throughout the last couple of years that we've owned it. So you're going to see a true kind of A to Z analysis, a true beginning, middle, and near the end here of stabilization on a true value add apartment complex. So that's what we're going to talk about today. Here we go.
Welcome to the Accelerated Investor Podcast with Josh Cantwell. If you're looking to retire early with forever passive income, you're in the right place. This podcast is the go-to destination for real estate investors, both active and passive, and multifamily apartment investors, both new, intermediate, and advanced. Now, sit back, listen, learn, and accelerate your business, your life, and your investing with the Accelerated Investor Podcast.
Okay, guys, well, welcome back. Listen, 220 Chevy. So let's talk about this deal for a quick minute. If you remember, the property here is called Forest Ridge Apartments. You can look it up online if you want to check it out. It's on Chevrolet Boulevard in Parma, Ohio. So if you're listening to this in front of your computer or your phone, go ahead and type in Forest Ridge Apartments, Parma, Ohio. And you're going to find the apartments.com link. There you can check out the photos and the pictures of the property. And if you do that, you're going to see that the property looks amazing. It did not always look this way. If you're looking at the apartments.com photos, you'll see all the new, all the granite, all the butcher blocks, all the LVP flooring, the grounds, the new awnings that we put at the leasing office. You're going to see the new signs that we put in. It's really, really amazing what we've done to this building. But let me tell you how we started. If it's the first time you've seen an update on this property, we bought this property all the way back in April of 2021. So this was a little over 2 years ago. And in April, when we bought it, the total revenue that had come in that month was only $115,000 of revenue. We bought the building, it was about 91% occupied, but the rents, if you take, let's just do the math together real quick. If you take 220 units at 91% occupied, that's roughly 200 occupied units. If you take $115,000 a month divided by 220 units, 115,000 divided by 220, it's only $522 a month. Okay, if you factor in all of the units. If you take 115,000 and divide by 200 occupied units, the average rent was only $575. Now, this deal is in Parma, Ohio. I went to high school in Parma, Ohio. I went to Padua Franciscan High School. This is a very white collar, blue collar town. There's every business, every retail shop that you could ever imagine. Parma is the 5th largest city in the entire state of Ohio. It is a major suburb of Cleveland. It's extremely safe. It's very B class. There's 5 high schools there, including Padua, Holy Name, which is another private Catholic school. And then there's 3 public high schools. It's a huge, huge, huge city, but very just suburban, right? So this property is essentially being managed like a very C-class property by an out-of-town landlord. And we end up buying the building for $11.65 million. So you take $11.65 million and divide by 220 units. We bought it for only $53,000 a door. It'd be very hard to find a deal like that in today's marketplace, in today's environment, because prices have gone up all around. But the important thing to remember here is the price per door, right? 53,000. Remember that. Also remember that it was making $575 per month in rent, which is extremely low. So if you're only charging $565 for rent, you're probably attracting more of a C class or even a D class tenant that can afford $500 or $600 a month. That's very, very low rent. Now, fast forward from the time we bought it in April of 2021, fast forward to October of 2022, which is about 6 months ago from the time of this recording. And in October of 2022, the rent collected had grown from $115,000 a month to $176,000 a month. $176,000 just in rental income. I'm actually looking at the financials on my other screen here as I'm recording this. And we had some other income come in. We had some miscellaneous income. We had some late fee income, some laundry income, pet fee income, utility reimbursement income. You know, we brought in about $184,000 and we didn't even get paid any laundry income that month. Okay. And so you add it all up, about $184,000. Well, if you take $184,000, let's do the math. 184,000 and divide by 2, just let's assume it's a 50% expense ratio, and then multiply times 12, that's $1.1 million of net operating income. That's the trending T1. It's just 1 month, of financials, but a T1, right? And you get 1.1 million of net operating income. If you divide that by a 6 cap, that puts the building worth in that month worth 18.4 million bucks. Okay. So remember, I bought it for 11.65 million. Now it's worth 18.4 million. If you take 18.4 million and divide by 220 units, that raised the value from 53,000 a door to 83,000 a door in roughly 18 months. Again, we bought it in April of 2021. This is October of 2022, 18 months later. Okay. Now, one of the things that happens in Cleveland in our market is the weather. Okay. So we've learned over the last, several years, 5-6 years of owning apartments, that the leasing season stinks in December, January, February, March, because you have Christmas. Nobody wants to move at Christmas. You have January, February, it's 20 degrees outside. There's a lot of snow, a lot of ice, a lot of rain. The weather's just not great. And so we've began migrating all of our leases where the leases terminate, they end basically from April to October. Okay, April to maybe March to September. We do not want leases to terminate in November, December, January, February, because that's the hardest time to fill a unit. Okay, just because it's very seasonal. The weather is very seasonal. And so that was in October. Then in November, December, January, February, just like I mentioned, there were some leases that came due. People decided not to renew and move out. We turned a bunch of units. We turned those units, but we had a hard time leasing them all out because the weather sucks. Okay. And people don't really want to move. And, the Christmas holiday and then New Year's, and then, people didn't want to move. So in December, January, February, our income actually went down. And so you have a new kind of value of the building, right? So instead of collecting 184,000 of total income in March, right, a couple months ago, at the end of Q1, we collected a total of 167,000. Now it's still a huge improvement, right? From collecting 115,000 to 167,000 within 2 years. Still a huge improvement. So take 167,000 again, cut that in half for a 50% expense ratio, multiply times 12 to get your annualized income. That's $1 million. Divide by a 6 cap, puts the building value at 16.7 million. Again, bought it for 11.65 million. Based on this analysis, it would be 16.7 million. Okay, 16.7 divided by 220 units, that would be around 76,000 a door. Bought it for 53,000 a door.
Are you ready to automate and explode your real estate investing? We're searching for extremely motivated individuals who are sick and tired of wasting time and want to finally see real results from their real estate investing business. We're searching for investors looking to get to the next level and become a bigger, better version of themselves while being a more successful real estate investing entrepreneur. Apply for mentoring and coaching at joshcantwellcoaching.com/podcast. That's joshcantwellcoaching.com/podcast.
Now, the interesting thing that's happened is over the last basically 30 days or so, now that the weather's gotten nicer at the end of March, April, I'm recording this basically the 1st of May, we have seen a tremendous amount of leases. One, because tax season's over, a lot of people got their tax refunds. So now they're buying cars, they're buying houses, they're renting new units, people are moving out. Also, the weather's much better. People are getting out for leasing events. They're getting out for marketing. They're doing tours. They're not worried about, moving their stuff in the dead of winter. And so just in the last 30 days, we've leased out 15 additional units. And so our occupancy has gone up tremendously. Well, now we're leasing the 2-bedroom units. If they're fully turned and fully remodeled, fully upgraded, we're leasing those out for, my slide right here, a full turn's leasing out for $975. Now, remember what I said before, when we bought the building, the blended rent was $575. So if we raised the rent on a 2-bed, 1-bath full turn, raised it by $400 a month. Okay, so if you take 400 and divide by 575, that's a 70% rise in the rent in 2 years. 70%. Okay, now you don't get that in a lot of organic situations. You won't get that in the South. You won't get that in the Sun Belt. You won't get that in Columbus, Ohio. You won't get that in Atlanta, Georgia. But because this was a B-class building in a B-class market being managed like a B-class or even a C-minus, it was a tremendous opportunity to do a pretty heavy value add and raise the rents. Okay. And so if you look at that total bump, it's a huge bump. Okay. So now we're on pace this month. I just got the rent roll. It just came into my inbox. So let me bring this up. It's right here. And when I look at the rent roll for this month coming up, here we go. Our rent roll has grown substantially, especially with filling the vacancies that we had. So our scheduled rent that we're scheduled now to collect in the month of May, based on these 15 move-ins, is actually $189,000. Okay. So let's say we don't collect 5% vacancy or non-collection. We're scheduled to collect $189,000. 5%, that would be $9,000. So we collect $180,000 plus the other income, laundry income, late fee income, etc. It's going to be somewhere around $185,000. Okay, so again, let's do the math. 185,000, right? Times 0.5, it's 92.5 per month. Times 12, it leaves me a net operating income of 1.1 million divided by a 6 cap, puts the value back at 18.5 million bucks. Okay. And so that's one of the reasons why we love this business. One of the reasons why, investing in Cleveland makes a lot of sense for us, but especially because we have the ability to execute our value add plan, the ability for us to handle the construction, the ability for us to turn units, remodel units, upgrade units, and that allows us the ability to really force the appreciation in buildings. Okay, from 11.65 million to today, which would be about 18.5 million. Even if you take October, it was at 18.5. It dipped down in the middle of the winter to about 16.7 million. So all these are off of the trailing 1 month. But once now we're going to be stabilized this summer, we'll stay highly collected, highly occupied, very few evictions, very few move-outs. We're also adding some amenities, a dog park. We put in new laundry facilities there. We don't expect much of a move out, right? We should be at full occupancy, maybe with 5% vacancy, 1% maybe with non-collections. So you're collecting 94% of the income that's on your rent roll. Then, this building's value is right at around 18.5 to 19 million. We go into Q4. My plan is that over the summer, I think interest rates are going to top out. Then by Q4, they're actually going to start going down. And the forward-looking curve indicates that, interest rates are going to start going down next year. And then by then, we should be able to get lower interest rates. I'm still sticking with a 6 cap. I penciled this originally at a 6.25 cap. Interest rates have gone up, so maybe interest rates affect cap rates. Cap rates expand a little bit, go up, which means values go down. And I think interest rates are going to go back down by the end of the year, which means cap rates will stick at around 6.25, leaves our value at somewhere around 18.5 million bucks, which leaves us, we're into it for about 13.5, which leaves us almost $5 million of booked equity on my balance sheet, my partner's balance sheets, my limited partner's balance sheets. You really can't do that, unless you do some significant value add, right? Some significant program that allows you to raise the rents by that much. Raise the rents from literally $575 to $895 on a 1-bed and $975 on a 2-bed. It's amazing, right? And so that's how you operate a building. That's what we've done. That's how we've gotten there. We spent about $1.4 million in capital improvements. We improved all the commons, all the lighting, the paint, the carpets. We turned over 140 units. And when I say turned, I mean remodeled, significantly upgraded, significantly remodeled 140 units. That's what allow us to charge more rents. And we're just going to stabilize it out. We're going to refi it, and we're going to cash flow it forever. That one deal, if you did that deal or someone else did that deal, that one deal changes someone's life. When we structured this deal, we paid our investors a 10 pref, and we gave up about 22% of the equity, which means me, Glenn, and Tyler own 78% of the equity. Okay. And so let's just round it up to 80%. 80% of 5 million is 4 million. Okay. And so that adds that 4 million to me, Glenn, and Tyler's balance sheets. That's a game changer for a lot of people to, have one deal that's $4 million to their collective balance sheets. That's significant, right? Many people never even buy $1 million, let alone $18 million worth of real estate. To get $4 million to add to their balance sheet allows you to do a lot of things. It allows you to sponsor a lot of loans, buy more real estate, get more cash flow, all the things that you want to do to create long-term wealth, long-term forever passive income. That's what we've done here at 220 Chevy. So I hope you enjoyed this case study. If you did, like, subscribe, rate, review. As always, it would mean so much to me if you would share this all over social media. And if you want to do this for yourself, you got a couple options. One, right? Join me live during our live events. You can get a ticket to one of our virtual live events at foreverpassiveincome.com. You can also apply to be part of our mastermind group and coaching program at joshcantwellcoaching.com. That's primarily intermediate to advanced residential investors who are also kind of new to intermediate commercial investors, and they're trying to be advanced commercial apartment investors. That's who's in that group. So if that's you, then it's the perfect group for you to help you pivot and level up to be an advanced commercial multifamily investor. Go apply, see if you qualify. My program director, JJ and Alec, they will interview you to see if you're a fit. And if you are, they'll extend you an invitation. You can jump in. So foreverpassiveincome.com, joshcantwellcoaching.com. Like, subscribe, rate, review, share. Thank you so much for being here. We'll see you next time. Take care.
You were just listening to the Accelerated Investor Podcast with Josh Cantwell. If you enjoyed this episode and learned something new, help us build the AI community by leaving a review and 5-star rating on our iTunes podcast channel. Also, don't forget to subscribe so you never miss another episode. To see passive investing opportunities, visit freelandventures.com/passive. To start your journey toward the lifestyle you've always dreamed of with multifamily apartments, apply for one-on-one coaching with Josh at www.joshcantwellcoaching.com.